Hello class, and welcome to Chapter 1 of Managerial Accounting with me, your instructor, Al Taccone. By now you have viewed and studied the orientation videos for the class, both the course orientation and the syllabus orientation, so we're ready to go with Chapter 1. And as you learn through the orientation videos, I like to keep the lectures to about an hour, less than an hour if possible, but around an hour. And as you know also, for this particular course, along with the lecture videos in the content for the course, you're also going to find the PDF version of the PowerPoints that are used in these lecture videos. So again, for those locations, where to find them, and for everything else for the course, again, you want to go to our course and make sure that you view the orientation videos and select exactly where the lecture videos are. But since you're here, that means you found me and you found Chapter 1. So without further ado, let's get into Chapter 1. Welcome to the course again. I'm looking forward to working with you all semester. And again, if you do, keep up with the work. You'll have no problem at all doing well. Make sure you contact me with any questions or issues, and I'll be happy to go over anything at all with you. And remember to post any questions or concerns to the weekly discussion board forum so that everybody can benefit from the questions and answers. All right, Chapter 1 is obviously going to be an introduction to managerial accounting. You've already taken financial accounting and completed it successfully. Not that this necessarily builds exactly on financial accounting, but you do need a strong financial accounting background to be successful. So Chapter 1 is all about the concepts and principles centered around managerial accounting. The learning objectives for every chapter I'll divide up into 3 categories. One is conceptual, the second category is analytical, and the third is procedural. Conceptual is really going to be based upon accounting concepts and principles. Analytical would have to do with what you're going to use the information for as you study. In other words, decision making usually when we talk about analysis. In other words, you see the objective assess there. Assess means you're going to use critical thinking. And procedural is going to be the mechanical aspect of managerial accounting. It wasn't financial as well. And that is, what do we really have to do mechanically to accomplish what it is that we need to for the managerial aspects of an accounting cycle. I'll just go through these quickly with you conceptually. As a result of studying Chapter 1, you should be able to explain the purpose of managerial accounting, describe accounting concepts useful in classifying costs. That's a big part of managerial accounting. Define product and period costs and how they impact financial statements. You should be able to differentiate between balance sheets and income statements for service companies versus manufacturing companies. In financial accounting, you studied service companies and merchandising companies. Here in managerial accounting, the focus is on manufacturing companies. Fifth, you should be able to explain the manufacturing activities and the flow of manufacturing costs. Describe trends in managerial accounting, and that should wrap up the concepts. Analytically, as a result of studying Chapter 1, you should be able to assess raw material inventory management using raw materials inventory turnover and days sales in raw materials inventory. Those are ratios. You probably studied financial ratios in financial accounting. Well, managerial accounting has them as well. You might remember inventory turnover in financial accounting, for example. Here it's similar, except we're dealing with raw materials inventories because we're working with manufacturing companies. Companies that take raw materials and turn them into something for the end consumer, the end user. Procedurally, by the end of studying Chapter 1, you should be able to compute cost of goods sold for a manufacturer and for a merchandiser. As I mentioned or reminded you in Chapter 1, in financial accounting, not in Chapter 1. In financial accounting, you studied accounting for a merchandising company or a merchandiser, and you learned how to calculate cost of goods sold. Here, we're going to do the same thing, but for a manufacturer. And second, you should be able to prepare a schedule of costs of goods manufactured and explains its purpose and link to financial statements. So a lot of focus on Chapter 1 on concepts, but procedurally, you'll also should have an introduction and start to grasp the concepts related to costs of a manufacturer in producing final goods from raw materials. So those are the learning objectives, and as we go along, you should be reminding yourself that this is what you should be accomplishing. All the rest of the things that you're assigned to do in the course revolve around these objectives. So everything that I've assigned to you, whether it be through your homework or any of the other activities through the course of the week, including the exams when the time comes, are all centered around making sure that you accomplish these objectives. All right, so let's get started. Some basics about managerial accounting. A simple definition here, managerial accounting is an activity that provides financial and non-financial information to an organization's managers. Again, the accounting function is meant to provide or to communicate to management and sometimes external users, but really one of the big differences between financial accounting and managerial accounting is financial will also provide a lot of external information. In other words, to folks outside of the organization or businesses or industries or banks or financial institutions outside of our company who are making decisions about our business. Managers need more than just the general purpose financial statements that you learned in financial accounting and what are used in a financial accounting system. So this particular section of Chapter 1, we're going to go over the purpose of managerial accounting, also called management accounting, and compare it to financial accounting. So if you've studied, and you should have by now, completed financial accounting, we're going to do a comparison between the two so you can actually see what the differences are and come to a conclusion or a beginning of a conclusion for what you're going to be studying and learning in managerial. Here are the purposes of managerial accounting, really as we mentioned, or I just mentioned, to provide useful information to managers of the organization. Again, that's an internal part or use for managerial accounting, and that's a big focus as opposed to financial, which does both internal and external. Managerial accounting helps managers with really three key tasks. Number one, determining the cost of an organization's products and services. Second, planning future activities for the organization. And third, comparing actual results to planned results. So management will determine costs. Second, planning future activities and what should we do for the future in terms of production. And third, comparing what actually happened as a result of what we did and planned and performed to what we had planned on happening, so that we don't repeat our errors and we can make corrections as we move forward. The nature of managerial accounting really differs, and the way we're going to look at the nature is how it differs from financial accounting. There are 7 key differences between financial accounting and managerial accounting, and they're outlined here. I might go through a few of them with you, but you can read them on your own. Users, for example, which is the one we've been focusing on so far. In financial accounting, the external users are the investors, creditors, and other outside of the management of the organization who are going to maybe invest in our company, make decisions whether they want to loan us money, grant us credit, etc. Whereas in managerial accounting, the focus is on internal users, management, employees, decision makers that are inside the organization. So a bank, for example, which is a lending institution on the outside of our organization, would be deciding whether or not to lend us money. From a managerial perspective, management would be deciding whether or not we should even go outside the organization to borrow money. That's an internal decision. Purposes of information. Financial accounting will provide or help external users make investment decisions, as I just mentioned, credit and other types of related decisions. Whereas in a managerial accounting perspective, it helps managers to plan and control decisions. So take a look at this particular slide closely. I don't want to read it all to you because it's pretty self-explanatory, but keep in mind there are these 7 differences between financial accounting and managerial accounting, and in this particular course we are studying column 2, which is managerial accounting. I just want to point out one other maybe to highlight, and that's number 7, the nature of information. Financial accounting, really the nature of the information provided to external users is monetary in nature. Managerial is monetary for the most part, but also can be non-monetary. In other words, when we look at production, a lot of it, yes, there's costs involved, but the non-monetary information might relate to how effectively and efficiently we're producing. In other words, if we produce something using different raw materials, doing a quicker process for production, a more efficient and effective process for production, that may have an impact on our finances for that period. So once again, the 7 differences between financial and managerial accounting. Let's take a look at, as we do whenever we study accounting, whether it be financial or managerial, fraud and ethics in relation to managerial. You probably studied this to some extent with financial accounting as well. But these are important factors in running any business and any business the operations that are involved in business. Fraud involves the use of one's job for personal gain through deliberate misuse of an employer's assets. For example, theft is an example of theft of an employer's cash or other types of assets that the employer owns. Overstating reimbursable expenses. In other words, you took a trip that was going to be reimbursed by the employer and you overstated those expenses. You really spent $200 on hotel, but you're claiming you spent $300, or you spent more on lunches and dinners and breakfasts. Payroll schemes, you probably studied in financial accounting as well. Creating fake employees or paying people more than they actually earned. Financial statement fraud, just very simply reporting fraudulent data on financial statements. 3 key factors must exist for a person to commit fraud: opportunity, financial pressure, and rationalization. This is known as the fraud triangle. Fraud affects a business and it costs them, and this is based upon a 2014 report to the Association of Certified Fraud Examiners. It estimates that it's about 5% of the annual revenues that businesses produce in the United States is lost to fraud. So once again, one of the jobs of an accountant is to help to combat fraud. It's really everybody's job in an organization, but it requires ethics, and it requires us to conduct ourselves ethically and to get others in our organization to do so as well. Ethics, again, you probably studied this in other courses or in financial accounting, are the beliefs that distinguish from right and wrong. A person who has the ability to distinguish between right and wrong is considered to be ethical. It's our job to ensure that from our standpoint, management accountants, really all accountants, are all members of the organization, but since we're studying managerial, the Institute of Management Accountants requires that management accountants be competent, number 1. Number 2, maintain confidentiality. Number 3, act with integrity. Number 4, and finally, communicate information in a fair and credible manner. Not much different than what any accountant would do. So the IMA, the Institute of Management Accountants, just kind of solidifies that a little bit more and specifies it to management accounting. It's what we call a code of ethics, and most types of businesses will have a code of ethics to help guide how an organization or how we act individually within our organizations or even in our personal lives. All right, that's a little introduction to the differences between financial and managerial accounting, and of course a little discussion on fraud and ethics and our obligation as management accountants to uphold integrity and ethics within our organization. We're going to start now taking a look at the different types of costs and the behavior of costs from a managerial accounting standpoint within an organization. Here on this particular slide, you see the difference between what are called total costs and fixed costs. At the most basic level, a cost can be classified by how it behaves with changes in volume of activity. In other words, if you increase the amount of a business's activity and costs change along with it, that's a variable cost. If costs do not change with changes of level of activity, that's called a fixed cost. Just to give an example of something that might relate even to financial accounting, when you pay rent or a lease amount, or a mortgage. Every month you have to pay that mortgage or whatever it is that you're paying for the use of space, regardless of how much you sell or how much you produce in that space. The bank wants its money or the landlord wants their monthly rent. That doesn't change. If, however, you have employees, you buy supplies, etc., to operate your business, whether it be manufacturing or sales, it really doesn't matter. Those are variable costs because you can reduce the number of employees you have based upon need, the number of supplies you have. You might even be able to cut costs in utilities by not operating machinery and equipment as much. And certainly from a managerial accounting standpoint, by reducing the amount of materials that you're using because you're not producing as much, that raw materials costs will also drop. So for now, taking a look at classifications, just remember the difference between total fixed costs and total variable costs. Total fixed costs do not change when activity changes, and total variable costs change in proportion to activity changes. And again, the proportions will vary based upon how much the change is and what the costs are. But just to give a simple example, if you reduce production in your facility by 10%, variable costs proportionately could change or be reduced by 10%. Whereas if you're paying $10,000 a month for a lease on that factory or that operation, it doesn't matter if you reduce productivity by 10%. You still have to pay that $10,000 for the lease or the mortgage. On the left of the slide is what's portrayed graphically. The fixed cost is a flat line against activities because, as you can see here, as activities increase from the intersection of the axes left to right, and here's the cost line, the costs do not change. It's parallel to activities. Whereas from an activity standpoint, as activities increase, variable costs increase proportionately. That's why the line, if you have no activity, the variable costs are zero. That's what's here at the intersection, and they will increase proportionately to increases in activity. Here, a fixed cost, like I said with the rent, might be up here at $10,000. Doesn't matter how much you produce. Even if you're on the line and you produce zero, you're still paying your $10,000 rent. So if you produce nothing or you produce infinity, you still have to pay the same amount of rent. Hopefully that makes sense, but again, one of your jobs is to go back and study your material, read your chapter, and complete all of your work each week to make sure that you have that mastered. So that's the difference between total fixed costs and total variable costs. Now we'll take a look at costs that are classified by what we call traceability. This is when a cost is traced to its cost object, which is a product, process, department, or customer to which costs are assigned. Direct costs, which you see in the two bullet points on the left, are traceable to a single cost object. For example, material and labor costs for a product. So if we are producing a particular product, we trace the costs that are traceable to a single cost object would be tracing the cost to the labor that it costs to produce that product, the material it costs to produce that product, or something along those lines that's related to specifically production of that particular product. Direct costs, as I said, are traceable to single objects. Indirect costs cannot be easily and cost beneficially traced to a single cost object. They can't really be traced easily. For example, a maintenance expenditure. If, for example, you have a production facility, and we'll just, for sake of argument, just say 50% of the facility is used for production and 50% is used for administrative tasks, offices, accounting functions, management functions, etc. But you have to have maintenance to fix the roof, just to give an example. Two different departments are benefiting by that maintenance expenditure. You have to do a little bit more work to figure out what that indirect cost is. On the other hand, if you compare that to a direct cost, when you look at labor, we can pretty much tell how much labor is used to produce a single item or object. We can tell how much raw material was used to produce that object. But in the case I just gave you with fixing a part of the production facility, that's a little bit more difficult to trace because we have to figure out exactly what percentage or what amount of that particular cost went into producing our products. And I hope that, again, we're doing a quick overview in this chapter. A lot of these concepts come back throughout the course. We're just setting the foundation. So I hope though that gives you a little bit of an idea. But again, you got to keep practicing, read your chapters, and do all of your work each week to make sure that you have the material down. We can also classify costs by function. All production, or you might want to look at it from the standpoint of factory costs, are product costs. Product costs are those production costs that are necessary to create a product, and they consist of, you see on the slide here, direct materials, direct labor, and direct factory overhead. Overhead refers to production costs other than direct materials and direct labor. Product costs are capitalized as inventory during and after the completion of the products. In other words, once we start producing the product, they start to be included in inventory. That's what we mean by capitalized. Once the products are completed, they become a finished good. They're recorded as cost of goods sold when they're sold, just like they are were when you studied accounting for a merchandising company. So just to reiterate there, product costs are capitalized as inventory during and after the completion of the products. In other words, you start the product production all the way through the completion, they're considered inventory. When they're sold, they're considered cost of goods sold, similar to when you sold a finished good in a retail operation. Period costs are non-production costs and are usually more associated with activities linked to a time period than with completed products. Some common examples of a period cost would be the salaries of the sales staff, the people that you're paying to actually sell the products that you're producing. Wages of maintenance workers, advertising expenses, depreciation on office furniture and equipment. These type of period costs are expensed in the period when they're incurred, either as selling expenses or as general and administrative expenses. Again, I know I keep referring back to financial accounting, but when you studied your income statements for financial accounting at some point, you divided your operating expenses into general and administrative expenses and selling expenses. We're talking about the same thing here. Your manufacturing costs are all of the cost of producing your product, but the sales salaries, for example, of the people who sell the product, the maintenance workers who take care of the facility, are administrative costs, advertising, etc. Those are all period type of costs. We pay them over a period of time. They have to be paid. They're not the same as obviously direct labor, where we know that the cost that we paid for a person to help produce a product is directly related to that particular product. So just remember, period costs are expenses that are not attached to the product, whereas direct labor, direct material, and manufacturing overhead are directly attached to the product. In a financial statements, this is just a flow chart of what it would look like in terms of period and product costs. So if you follow the flow chart on the screen, it's left to right. Using 2015, any costs that were incurred, just as an example. If we divide those up into period costs versus product costs, you can see here, in terms of product costs, once we produce those products and they become part of inventory, inventory sold during that period would be cost of goods sold. Any inventory not sold during 2015 or by the end of 2015, that becomes the ending inventory for 2015, including your raw materials, your work in process. Those are products that you have on the assembly line, let's say, or they're not finished yet because they're still in production. And of course, the finished products are the ones that are. Raw materials are the raw materials that are sitting there waiting to be manufactured into end goods. So if you go up here to your period costs, you can see those directly relating again to the income statement. Cost of goods sold, as you remember, is part of an income statement. So are your operating expenses. But cost of goods sold is a product cost operating expenses are a period cost. Both belong on the income statement, but they're two different types of costs. Then, when you look at the end of 2013, you have all of that inventory. Hopefully, if all goes well, you're going to sell it, or a lot of it. And of course, you'll be producing more, so more will be going into inventory. But we're talking about 2016 now. Inventory sold that's still sitting there at the end of December 2015, sold during 2016, becomes cost of goods sold in 2016. So whatever sold in 2015 is in the 2015 income statement. What is sold in 2016 in our example would be obviously in the 2016 income statement. So take a look at that flow chart. Again, from a cost of goods sold standpoint, it's really not that different from the merchandising company. What is different is that since we're producing, the inventory is going to be made up of raw materials, which is raw materials is sitting there waiting to be manufactured, work in process, which is the raw materials that are in some stage of production, and the finished goods, which are done being produced and are ready to be sold. And then some of them become cost of goods sold, some of them become ending inventory and are sold in the future. So again, hopefully that's not, we don't mean that, or I don't mean that flow chart to be complicated. I think it actually helps you, again, and based upon my description of comparing to the financial statements, and particularly the income statement, from a financial accounting standpoint, it helps you to see the differences. Identification of cost classifications. It's really important to understand that a cost can be classified using any one or any combination of three different means that are described here on the screen. Describing how to classify costs in several different ways will enable managers to use cost information for a variety of decisions. Just take rent for a factory, since we're talking about managerial accounting. Factory rent is classified as a product cost. It is fixed, as we've talked about earlier, with respect to the number of units produced. In other words, your rent is going to be the same regardless of how much you produce. And it is indirect with respect to the product. Potential multiple classifications are shown here on this slide using different cost items incurred in the manufacturing of mountain bikes. That's just our example here. The finished bike is the cost object. Proper allocation of the costs that you see here and the managerial decisions based on cost data depend on the correct cost classifications. So if you just go over this slide, just kind of either freeze it or look at the PDF version of the PowerPoints later. Bicycle tires and wheels is considered a variable cost because you have to use as many tires and wheels as you produce bicycles. It's a direct cost because it's directly linked to the manufacturing of the bicycles, and it's a product cost, again, because the bike tires and wheels are used on the bike. Now, the wages and assembly worker has a combination of all three. It's a variable cost because what it costs from a labor standpoint to produce bicycles depends on how many bicycles we're producing. Fewer bicycles means we had fewer labor costs. They are, however, direct costs because the person producing the bike or the people are directly linked to producing that bicycle. And again, like with the tires, it is a product cost because we are talking about those costs being directly related to the bicycle. Notice there's a little asterisk there. Sometimes wages are classified as fixed. In other words, you might have a union contract or people who are on salary where you have to pay them a fixed salary every week or every month, and then it would become fixed. But wages, usually, we're talking about hourly or by the amount of time the person's employed. Again, I won't go through all of these, but advertising, that's a fixed cost. If you make a contract, for example, with an advertising agency or some form of social media where you have to pay a fixed fee, you're going to pay it regardless because it's a contract, regardless of what you're producing. It's an indirect cost because it's very, very difficult to link, as we said earlier, to the specific product that we're producing. And it is a period cost for the same reason we might be paying our advertising expense for the year 2016 or the month of February, whatever it happens to be. Remember, that's a period cost. It's not a product cost because I'm not linking the specific advertising cost to each bicycle that I produce. And you can see other examples here: depreciation, which you studied in financial, oil and grease applications. So one of the things I would say is, since you know these are the answers, is you might want to take a little bit more time to dissect this slide and analyze this slide, maybe even cover it up, and see if you can fill in the blanks. And there are some examples in your textbook as well, some exercises and problems also that are assigned and you might have in your quiz, or you might be studying in the chapter. That'll further help you to delineate between these types of cost classifications. Again, it's hard for me to tell because I'm not looking at you whether you get it, and you're not asking questions because we're not interacting at this time. So please do remember, and I'll mention this once in a while, go into our course, post a question or a comment to the discussion board for this particular chapter so I can respond to you and your classmates might respond to you. And also always send me emails if you'd like to as well. As you know, I respond in way less than 24 hours. All right, cost. Let's take a look at cost concepts with service companies. This was probably the first type of company you dealt with when you studied financial accounting, so you should be very familiar with these. This is how they're generally related. The cost concepts we just looked at are also applicable to service organizations. If you look at an example, we'll just look at an airline like Southwest Airlines, and assume that the cost object is a flight. In other words, every time a flight is in the air or it takes off, there are costs associated with it. The airline's cost of beverages for passengers is variable based on the number of flights. The more flights, obviously, that take off, the more beverages are going to be served. The monthly cost of leasing the aircraft is fixed, though, because when you're leasing, just like when you're leasing a car for yourself, if the car sits in the garage all month and you never use it, you still have to pay the lease payment on it. Same with the big ticket items like airplanes. We can also trace the salary of the flight crew to specific flights. In other words, you might have crews that are going to specific flights or routes that Southwest Airlines has. Their wages can be tied directly. Classification as product versus period costs isn't really relevant to a service company because services are not inventoried. Remember, one of the big differences, if not the biggest difference between a merchandising company and service company, is inventory. Similarly here with manufacturing companies have inventory, as we just saw. Service companies do not. In a service company, you're really expensing on a monthly basis what it is it's costing you to produce the service. All right, so hopefully that gives you an idea of the cost concepts with service companies, since you have studied, or you did study them in the past. Again, conceptually, that really isn't very different. Here's just a slide that I throw in once in a while. They're called Need to Know. I might be cut off a little bit at the top of your YouTube video here. But this just gives you an example of the cost of a company that manufactures computer chips. And it's a little example where you're classifying each as either a product cost or period cost. Then you're classifying each of the product costs as direct material, direct labor, or factory overhead. So again, I'm not going to go over this slide in particular. These need to know slides that you were going to see periodically in every single chapter, they're there for you to kind of pause and study because they're examples of concepts and procedures that we've covered to that point in the video lecture. I don't have a lot of them all the way across every single chapter, but occasionally I found them to be useful. And here, since we're in chapter 1 and you're really in this early stage distinguishing between types of costs, I think it's a good idea to take a look at this one so that you know the differences, or you learn even further and master the differences between direct material, direct labor, and factory overhead as product costs, and comparison as compared to, I should say, period costs. And at the bottom, just a reminder, your product costs, those are all of your factory costs. They're probably assets on the balance sheet like property, plant, and equipment in your factory. Period costs are your non-factory costs. They're expensed on the income statement, and we've already looked at those a little bit earlier. Your selling and your general and administrative costs that you're familiar with. Here's a slide that depicts typical manufacturing costs in today's products. This is just in general. If you were a company that did manufacturing, how your costs are probably going to be distributed. About 45, you can expect about 45% of your costs to be in direct materials. About 15% of your costs would be in direct labor, and 40% would be in factory overhead. And again, this is not a hard and fast rule. Obviously, this is just in today's marketplace. We're talking about, the mid part of the 2000 teens. This is what you can expect to cost per area if you were in a manufacturing company or you owned a manufacturing company. Let's go in a little bit more detail on the types of materials and types of costs that you're going to be dealing with here in managerial accounting studies. Direct materials are tangible components of a finished product. Remember, tangible is something you can touch, you can feel it, you can move it, it has substance. Direct material costs are the expenditures for direct materials that are separately and readily traced through the manufacturing processes to finished goods. For example, direct materials in manufacturing a mountain bike, the example we've been using all along, are the tires, the seat, the frame, the pedals, the brakes, the cables, the gears, the handlebars, all of those different parts of a mountain bike. Here on the slide, I just put a couple of those examples. But remember, those direct materials, they're tangible components of the finished product. All the things that I just read are parts of the bicycle. The direct material costs are the expenditures for direct materials that are separately and readily traced through the finished goods. Okay, so this example is direct material costs. Direct labor, again, it's almost self-explanatory, but it refers to the efforts of employees who physically convert materials to finished products. This is the people, or these are the people costs related to producing. Direct labor costs are the wages and salaries for direct labor. So the direct labor is the actual effort of the employees. The direct labor costs are how much we're paying them for that effort. They're separately and readily traced through the manufacturing process to the finished goods. For example, if we want to continue the mountain bike example, the wages paid to the person or people that are assembling the mountain bikes. So anyone who's involved with manufacturing the mountain bikes, that's called direct labor. What we pay them are called the direct labor costs. So the effort is the labor, the costs are what we're paying for that labor. Factory overhead, which is also, you might hear referred to as manufacturing overhead, consists of all manufacturing costs that are not direct materials or direct labor. So if they're not the two things we just studied, direct materials or direct labor, they're factory overhead. Remember, and as a result, factory overhead costs cannot be separately or readily traced to finished goods. We've already talked about that. Some examples that you see here, again, this could be the mountain bike factory again. The maintenance on the facility and the equipment, cleaning supplies that you buy to clean the factory, clean the areas, keep the machinery and the equipment in working order. Factory utility costs, your electric, gas, however it is you're running your factory. Air conditioning is all part of electrical, all those type of utilities, telephone really doesn't matter, internet. And supervisory costs, that's the management personnel. Remember, that's overhead. It similarly was used in financial accounting, but really we didn't call it overhead there. What we categorized those on the income statement was really your general and administrative costs. We're a little bit more specific in how we define those types of costs in managerial accounting, and we refer to those as factory overhead. So the overhead is all the manufacturing costs that are not direct materials or direct labor. And this is a pretty good example. If you look at the last two slides on direct materials and direct labor and compare it to this slide on factory overhead, the differences should be clear, especially given what we've studied so far here in Chapter 1. All right, prime and conversion costs. Prime costs are expenditures directly associated with the manufacture of finished goods, which includes both direct material costs and direct labor costs. Conversion costs are expenditures that are incurred in the process of converting raw materials to finished goods. So those costs that we have to spend in order to do that conversion of raw material to finished goods are conversion costs. They include both direct labor costs and manufacturing overhead costs. So if you notice on this slide, direct labor costs are considered both prime costs and convention costs. So direct labor costs are both categories, prime and convention, whereas direct material is only a prime cost, and manufacturing overhead, as we just studied, is only a conversion cost. Again, because of the relationship to the product. So this is usually the flow that you will see. This is again just a pictorial of manufacturing costs and how they often are combined with one another. But there are your prime costs versus your conversion costs. Again, you're listening to me and I'm showing you pictorials, but in all likelihood, you're not. You should be going back to your materials and what I've asked you to study and complete each week for requirements to master the material. And hopefully you'll do that. All right, how do we report manufacturing activities? Companies with manufacturing activities, and that's what we're studying here in managerial accounting, differ from merchandising and service companies. We've already seen that quite a bit here in Chapter 1. The main difference between merchandising and manufacturing companies, as we've restated, that we'll restate here, is that merchandisers buy goods that are ready for sale, while manufacturers produce goods from raw materials and labor. So remember, when you were dealing with a merchandiser, like a retail operation or a wholesale operation, the seller, who ends up selling to the end consumer, is buying those products for the purpose of resale. Here in managerial accounting, we're studying manufacturing activities, meaning raw materials are coming in, the manufacturer is taking that raw material and making it into something called a finished good that will eventually be sold to an end user, who we commonly call the consumer. The merchandisers don't do production. You can see kind of cute little pictures here. The sale mart, the little store, they're not producing anything in the little store. They're buying things to sell. The manufacturer on the right, with the smokestacks there, pardon the pollution, is manufacturing goods that'll end up being sold possibly to the little store that's over here. All right, so that's really a pretty good summary of the difference between what you've studied so far with merchandising and service businesses and manufacturing that we're about to study here in managerial accounting. Therefore, when we look at the financial statements, starting with a balance sheet here, the balance sheet for a manufacturer is still going to have categories for current assets and all the other type of assets you've studied, but let's take a look at the difference between the merchandiser and the manufacturer. The real difference, or the main difference, is in inventory. On the left is the classic current assets section of a balance sheet that you studied when you looked at merchandiser in financial accounting. You had an account, which is a current asset, merchandise inventory. Remember, current assets are the ones that are most easily converted to cash and quickly converted to cash. Whereas if you look here on the right of the slide, the manufacturer's balance sheet in the current assets section is going to have these three type of inventories that we studied a little bit earlier: raw materials, goods in process, and finished goods. All of these are inventory, and then we learned your cost of goods sold will come out of the finished goods. By the end of the year, or however long your accounting cycle is, you will have produced a number of goods for resale. The ones that have been sold is your cost of goods sold. The ones that still remain are your ending inventory for that year, which, as you know by now, becomes the beginning inventory for the subsequent year or period. So that's really your major difference. It's that simple. Between the manufacturer and merchandiser is you have three different inventory accounts, if you will, in the current assets section of the balance sheet for a manufacturer versus just merchandise inventory for the merchandiser. So when you look at the balance sheet and how it's going to end up being structured without looking at actual numbers or the actual format for the balance sheet, The way you'll see the current asset section with the three inventories: raw materials. These are just the definitions for each. Raw materials are materials that are just waiting to be processed. They're stored. They're waiting to be taken into the factory to be produced into something. Goods in process are partially completed products. You've taken some of the raw materials into the factory, and they're at some stage of production. And finished goods, those are obviously the completed products for sale. They've already gone through the assembly process, the manufacturing process. They are now stored somewhere, or they're out on trucks being delivered for sale, or they're in your own establishment if you happen to also sell in the same establishment where you manufacture, which is possible. But the point is, finished goods are the goods that are completely manufactured. Okay, and remember, for goods in process, it's material, labor, and overhead. So I want to point that out too. When you have a good in process, they're partially completed, but there is materials, labor, and overhead that have gone into production regardless of what stage of production. All right, so just quickly, if we go back to just the previous slide, there is what the manufacturer's balance sheet difference is between merchandising and manufacturing. And what we've done here on this slide, or what I've done, is to divide up the definitions for the manufacturer's inventory that's on their balance sheet: raw materials, goods in process, and finished goods. Now let's take a look at the income statement for a manufacturer versus a merchandiser. On the left is what you're most familiar with from financial accounting. You have a beginning merchandise inventory. Remember, then you purchased some goods during the period. That's your cost of goods purchased. When you subtract your ending inventory from the cost of goods purchased plus the beginning inventory, these two numbers added together you might remember being called cost of goods available for sale. When you subtract the ending inventory, which is what you have left, you get cost of goods sold. For a manufacturer, it's a little bit different. You have a beginning finished goods inventory, which you've already produced, that's there, plus the cost of the goods that you manufactured during that period, minus the ending finished goods inventory. So the big difference is, in merchandiser, we're buying things for resale. Here, for in the manufacturer, we are manufacturing things to be sold. Both have cost of goods sold. It's just that your inventories are categorized as merchandise inventory versus finished goods inventory. And they both have a beginning, some amount that you add to those during the year, whether you've manufactured or whether you've bought merchandise in the case of a merchandiser, and you end up subtracting out your ending inventories to get cost of goods sold. Very, very similar to merchandising, with that big difference of manufacturing. And that whole purpose of managerial accounting is to study what those differences are and how to do the accounting for a manufacturing company. All right, here is in words and numbers what your cost of goods sold would look like for a merchandiser and a manufacturer. This is kind of the little section, or dissected out of, both of these blocks are, dissected out of the cost of goods sold section of an income statement. Beginning inventory plus cost of goods purchased, or merchandise purchased, gives you goods available for sale, as I mentioned on the previous slide. When you subtract your ending inventory, you get cost of goods sold. For the manufacturer, cost of goods sold, you have your beginning finished goods inventory, what you started the period with. Add to it the cost of what you manufactured during that period. Similarly, it gives you goods available for sale. And then when you subtract out your ending finished goods inventory, what you didn't sell from your inventory for that period, you still are going to get a number called cost of goods sold. So it only differs slightly. The two differ slightly. And I think by now I've gone over it and repeated it a number of times, hopefully not to get you too upset with me for repeating things over and over. But I've tried to focus on here what the differences are between the two by reflecting back to what you already studied and learned and mastered back in financial accounting. All right, this particular slide is another one of those need-to-knows where you could do a little bit of practice on your own and indicate whether the following financial statement items that are on the screen apply to manufacturer, merchandiser, or service provider. Some may apply to more than one, as you can see here. For example, and they give you the definitions of what each are that we've already gone over. Merchandise inventory would apply strictly to a merchandiser because they buy inventory. Finished goods inventory, for example, would be only applicable to the manufacturer because a merchandiser and service provider do not produce goods. They buy goods for reselling. However, cost of goods sold applies to both the manufacturer and merchandiser because they both sell goods, but not the service provider. Remember, they sell a service, they don't sell goods. Supplies inventory applies to all three because that's one of those costs that are general and administrative or overhead, as we've learned for a for a manufacturing company. Cost of goods manufactured can only be for a manufacturer because they're the only ones of the three categories here of business type that produce. So again, you could take a look at that a little bit more closely if you want to practice it a little more to get to actually master what the differences are between these elements as they relate to a manufacturer, merchandiser, and service provider. Because this is your first exposure. Managerial accounting should be your first exposure to manufacturing accounting. All right, as far as activities and cost flows in manufacturing, this is just merely a flow chart. And it's not something that you need to memorize or something that you need to know or that you're going to have to really reproduce at any point. But manufacturing companies will also prepare reports besides balance sheets and income statements to help managers plan and control the manufacturing process. And that's what you see here. To understand these types of reports, though, you first have to understand the flow of manufacturing activities and costs. This particular slide shows the flow of manufacturing activities and the cost flows of those same activities. As you can see here across the top row, the activities flow consists of materials activity, followed by production activity, followed by sales activity, and that should make sense. I mean, you have materials that have to be produced into something to sell, and then eventually you sell them, which is the sales activity. The boxes below those activities show the costs for each activity and how those cost flows across the three how those costs flow, I should say, across the three manufacturing activities. So these are the activities, the raw material flow through production to end up being finished goods that are sold. And we know that materials end up on the balance sheet, as do any work in flow or work in process, I should say, in finished goods. The one thing that appears on the income statement in this flow chart is the cost of goods sold, because that's part of the calculation of revenue for any type of manufacturing business or merchandising business. Again, that's just a flow chart to refer to if you'd like to for kind of a visual pictorial of the flows. All right, let's take a look at one of the common kind of reports, if you will, that a manufacturing management or personnel would look at to help make decisions. This one's called the Schedule of Cost of Goods Manufactured, which, as you can see here, summarizes the types and amounts of costs incurred in a company's manufacturing process. And, you know, we already studied there's direct materials costs, there's direct labor, there's factory overhead. Those three added together give you the total manufacturing costs, what it's going to cost you to manufacture a product. You add to that the beginning work in process, because remember, that's part of your inventory. You're going to have some work in process that you start the new period with, but you need to subtract from that the ending work in process. In other words, you have a beginning work in process, you're going to keep manufacturing those and other things that begin in process during that period. So at the end of the period, you subtract out the ending balance of your work in process, and that's going to give you something called cost of goods manufactured. So really what it is, you're taking your beginning work in process, adding to it all of the things you produced during that period, and then subtracting out what you finished, you know, which is your ending work in process, and that's going to give you your cost of goods manufactured. That just tells you how much the company had in cost for that period that are based on the manufacturing process. This is a busy slide. Busy from the standpoint of it represents the schedule of cost of goods manufactured statement for a manufacturing company. That's what we're studying here, obviously. So I'm not going to go through this in detail because we've studied all of these different elements so far. But this slide basically is giving you two things. One, what is included in the schedule of cost of goods manufactured, and two, the format that the cost of goods manufactured, the schedule of cost of goods manufactured should take when you prepare one. So you can see it's divided up into your direct materials costs, your direct labor costs, your factory overhead. And way down at the bottom is what you just saw in the previous slide, except we didn't use numbers, and that's your cost of goods manufactured. This slide just shows you the actual schedule of the cost of goods manufactured with all of the variety of costs. You can see here the factory overhead, all of these things, supervision, utilities, property taxes, depreciation, amortization for patents, which are your intangibles. All of those things are overhead, whereas the raw materials to produce are direct materials costs. Direct materials costs. Again, you'll have a picture of that in your textbook as well. But again, you can look at all the PowerPoint slides are available to you, as you know by now, in PDF version, should you want to print them or look at them in at your leisure, or one slide at a time a little bit more closely. So we're just going to quickly go through the sections here again because I showed you the overall schedule of cost of goods manufactured. So this slide is just reminding you that the first thing you do is calculate the raw materials used. So at the end, what we're really saying here is by the end of the period, the direct materials that you used for that period were $85,500, what you see here. The direct labor was $60,000. And that's what you see highlighted here on this next slide. The grand total of all of the direct labor costs for the period was $60,000. Remember, that's something we can calculate. We do know what it costs us in labor for what we manufactured during that period. That's what makes it a direct labor cost. The next section, the factory overhead. You can see here, eventually you have total factory overhead of $30,000. So the total manufacturing costs are adding together. Let me go to the next slide for that. Let me just slide over a little bit. Adding together your direct materials, your direct labor, and your $30,000 of factory overhead, which gives you your total manufacturing costs of $175,500. Then you get to your total, your work in process inventory at the end of the year, $2,500. The total cost of the work in process then is the total of those two, $178, because remember what you manufactured during the period plus the work in process inventory from the end of the previous period, 2014, means you had total work in process during 2015 of $178,000. By the end of 2015, your work in process is $7,500. So the cost of what you manufactured is the total cost of work in process, the $178,000, minus the work in process that you have as of December 31st of 2015. So your total cost of goods manufactured is the difference, which is $170,500. And that's consistent with not only what you're seeing here and in the overall statement or schedule that I showed you earlier, but it's consistent with what we've studied so far in terms of how we manage and calculate costs for the purpose of decision making. So again, you want to review that here and obviously in your text and all of the materials that you have, and as you can imagine, what you're going to be graded on for points in this chapter when you go in and do your work, if it's actually going to be graded that was assigned to you, is all related to this type of practice. And the other things we learn, not just this, but other things too. Overhead, this slide just depicts the overhead cost flows across accounting reports. You have a schedule of cost of goods manufactured. That answer, if you will, or the cost of goods manufactured for that period becomes part of the cost of goods sold for your income statement. You can see your ending finished goods inventory also becomes part of the balance sheet. I'd like you to look at this particular slide and compare it to what you know about a merchandising company, because they're very, very similar in terms of how you calculate net income and how your balance sheet ends up being turning out by the end of an accounting period. The difference here is you're calculating cost of goods manufactured using this schedule as opposed to just calculating cost of goods sold, which is all you did for a merchandising company, because you had a beginning inventory, you purchased more, and then you had an ending inventory. Pardon me, I'm taking just a little sip of water there as I keep talking. So you know it's really me here, live, doing this video for you. Here's another need to know. Again, I'm not going to spend time on reviewing the entire need to knows, but you should be taking a look at them for your own practice, especially if you feel like that you need more. And this one will help you to learn more about computing the three measures using the information below: your cost of materials, your cost of goods manufactured, and your cost of goods sold. Remember the T accounts? They're back. Here they are. Remember, we're talking about financial statements here and schedules, but all of these pieces of the financial statements, they are all accounts in your general ledger, and we'll be learning to use those throughout the course, these and much more, obviously. So there's a need to know for a little bit more practice if you want to go ahead and study that to learn a little bit more along with this one. This is just a continuation of the same need to know. So you have the previous one, that's the start, and then you can go on to the second page of that need to know for additional practice. They're not bad, they're pretty good if you take the time to do them. Like I said, you're probably better off though to look at my PDF PowerPoints so you don't have to kind of scroll back and forth in the video. All right, kind of toward the end of this chapter 1, and here we're going to just take a look at some basics about some trends in managerial accounting, some of the things we need to be aware about in manufacturing, customer orientation costs, the global economy, the fact that we're producing globally, so we have to be very cost conscious because we're competing against, here in the United States, for example, against the rest of the world for production. E-commerce, a lot of your sales, especially now, are done by e-commerce. You're buying and selling. Lean practices, that has to do with effectiveness and efficiency. A service economy, the United States and some economies really depend on service more than they do manufacturing. So you may not be, depending upon the part of the country or the world you're in, you may not have a whole lot of manufacturing that goes on. So it may be hard to find labor, for example. Just going to quickly go over what those elements are in a little bit more detail, some of those trends. Customer orientation, our concerns relate to total quality management, just-in-time manufacturing, orienting our customers, and continuous quality improvement. All of this really centers around ensuring that whatever we do, all of the decisions that we make and whatever we produce have the customer in mind, not only in mind, but at the forefront. So when we produce products, we want to make sure we're producing products that customers want. They're of quality, so they'll continue to want them. We're producing them effectively and efficiently so that the price that we offer our products to the customers is affordable and cost effective for us. Once again, they're only going to want to buy products that, remember, selling is all about how much a customer can afford and whether or not they want the product. So that's customer orientation. TQM, or total quality management, relates to a constant focus on higher standards. If you believe in TQM, you believe you never really have the highest of standards. In other words, you believe that there's always room for improvement in all aspects of business activities. You try to reduce and really eliminate waste. You try to find the waste first of all, then eliminate it. Encourage employees to use new methods to improve quality. Emphasize value through quality awards In other words, within your business, if somebody comes up with something that improves the quality of a product, you might give awards for that. Or it also is from this standpoint. If you want to get an award from an external agency that makes some types of awards like J Power, for example, if you focus on that, you're going to be involved in TQM consistently because you never really believe you've achieved the highest of standards. You always are striving for higher standards. With that comes costs, and with that comes aspects of manufacturing that we're going to have to ensure meet our goals. Just-in-time manufacturing is a system that acquires inventory and produces only when needed. An important aspect of JIT is that companies manufacture products only after they receive an order. It's also called a demand pull system. In other words, we don't produce products and then let them sit there and hope for a sale. Just-in-time believes you get an order or a series of orders and then you go into production and you produce enough to meet that period's sales, or purchase orders, let's say, so that you don't have a lot of inventory on hand. Remember, still, even with a manufacturing company, it's the same as with merchandising. Inventory that's sitting there isn't generating revenue. And you have to remember, when you're manufacturing, you've already paid through the processing to have that product manufactured. So if it's just sitting there in your inventory and not generating revenue, you're going to have no cost of goods sold. And you say, well, that's great, no cost. But guess what? You also have no revenue, which is not great. So the key is producing and manufacturing effectively and efficiently so that you're generating heavier profits. And one of the ways you can do that is through just-in-time, and that's not stockpiling inventory. Value chain refers to the series of activities that add value to a company's products or services. In other words, you might acquire raw materials, you bake them and make them into something that's a baked good, you sell them, and then you provide the service. You not only just sell the goods, but you deliver them. Might be the service. That's what you see there on the far right, is actually that service. Companies will use value chain usually to increase their efficiency and their profits. In other words, maybe I can get to my sales, or to the people who want to buy from me, my consumers, quicker if I handle some of that value added. From a global view, raw materials as compared to finished goods, your ending inventory versus your beginning inventory. Here's just an example in Swiss francs, just to give you an idea that the rest of the world does exist. Not everybody has dollars. The rest of the world does exist. In this case, we're talking about francs. And that gives you an idea as well of, from a global standpoint, the fact that things or elements like raw materials, work in progress, sundry supplies, finished goods, all of those exist everywhere. All right, one of the ratios you're going to learn in this chapter, and there are a number we're going to learn throughout the course, it's called raw materials inventory turnover. Raw materials that are used divided by your average materials inventory equals your raw materials inventory turnover. A business manager will use this to assess how effectively a company manages its raw materials inventory. The ratio will reveal how many times a company turns over, what we mean by turnover here is uses in production, its raw materials inventory during a period. Generally, a high ratio, a high answer here, of raw materials inventory turnover is preferred, as long as raw materials inventory levels are adequate to meet demand. What that basically means is when you buy raw materials, you want to use them as quickly as possible to manufacture. Because when you manufacture something, you have something to sell, rather than you just bought a whole bunch of raw material and it's sitting there not being manufactured into anything. And what we mean here, what I meant here, by as long as the levels are adequate to meet demand, you don't want to produce too much. So it's a delicate balance, and that's one of the parts of what we study in this particular course. It's a delicate balance between producing and selling. But the key is, when you buy raw materials, they're doing you no good sitting in a pile somewhere of raw materials inventory. you actually have to take those raw materials and manufacture them into something so they become finished goods, become part of your finished goods inventory, and hopefully generate revenue and offset with your cost of goods sold. And again, you will have some practice on that with what's required of you this week. Hey, that's the end of chapter 1. Congratulations, you made it. I'm not even going to look at my clock because I know I exceeded 1 hour on that one. I promise to do better in the future, but again, you're not seeing this live, so you can just scroll back and forth on YouTube. See more or less of me, faster or slower of me. But that is the end of chapter 1. Go back to your syllabus, go back to your course orientation, and make sure that you complete all of the requirements for chapter 1 by the date and time specified in the syllabus. I'm not saying it here on the video just in case people have different due dates based upon the class that I'm teaching, but you know by looking at the orientation video and you know by studying your syllabus and having it in front of you exactly when all of your chapter 1 requirements are due. So I've enjoyed being with you here for this video lecture. The PowerPoint version of the lecture, just in PDF, is also available to you. As I said, if you want to scroll, and of course this is in YouTube, so you can watch it as much as you want. Thank you very much. I've enjoyed it. I look forward to being with you for Chapter 2. For now, have a good day or evening, depending upon the time of day that it is, and good luck and best wishes completing all of your work for Chapter 1. Remember to post questions to the Chapter 1 forum or email me directly. And of course, always be looking for my posts of assignments to Blackboard that you'll always get by email. And also, sometimes I just send you messages by email as well. All right, thank you. Look forward to Chapter 2.